All right, let's get right into it. We are going to deconstruct one of the most complex and honestly one of the most controversial rules in all of state taxation. I'm talking about New York's convenience of the employer rule. It's a fascinating legal concept that has some very real and often very expensive consequences for anyone who works for a New York company but doesn't live in the state.
So, here's how we're going to break this down. First, we'll talk about what this rule even is, this jurisdictional bridge. Then we'll dig into the legal nuts and bolts, the actual laws and regulations. After that, we get practical, a forensic look at the exact tax form, IT-203-B. We'll examine the only way you could potentially get around this rule, which is the Bona Fide Office Test. Then we'll look at the long history of court cases and challenges. And finally, we'll zoom out and see how this all fits into the bigger picture of multi-state taxes.
So, the big question is, how on earth can New York tax you for the work you do while sitting at your desk in, say, New Jersey or Florida? Well, the answer is this rule. It's really best to think of it as a kind of jurisdictional bridge. It lets New York reach across state lines and tax the wages you earn as if you were physically working at your employer's office in Manhattan.
Now here's the absolute heart of the rule, and you really have to let this sink in. The default assumption is that if you're a non-resident and you're working remotely for a New York employer, the state just presumes you're doing it for your own convenience. The burden of proof is 100% on you to prove that it's a necessity for your employer.
Okay, to really understand this, we've got to look at the legal blueprint. And this is the first thing that surprises a lot of people. The convenience of the employer rule, it's not actually written into New York state tax law. Nope, it's a regulatory interpretation of some much broader statutes.
The whole thing really starts with this definition of New York source income from Tax Law Section 631. You see that key phrase, income from an occupation carried on in this state. The convenience rule is basically the state's very aggressive and, as we'll see, legally upheld interpretation of what that phrase actually means.
So let's look at how the statutes build this power structure. You've got one section, 601, that imposes the tax, another, 631B, that defines what income gets taxed. But the real linchpin, the crucial piece of the puzzle, is Section 61C. This is what's called an enabling provision. It explicitly gives the tax department the power to write its own rules for allocation, and that's the legal door that the convenience rule walked right through.
And here it is. This is the exact language from the regulation, 20 NYCRR 13.2.18a. Just notice how clear that wording is, of necessity, as distinguished from convenience. This isn't some kind of balancing act. It's a really high bar. Basically, the state's position is that if the work could have been done at the New York office, even if it wasn't, then it fails the necessity test. Simple as that. So, we've gone through the theory and the legalese. Now let's switch gears and get into the practical side of things. How does the state actually enforce this? How does this rule end up on your tax return? Well, it all boils down to one specific form, IT-203-B.
You can think of this form as the engine room of the convenience rule. Any non-resident who performs services both inside and outside of New York has to file it. And Schedule A on that form forces you into this day-counting methodology that's specifically designed to capture those remote workdays and treat them as New York workdays.
Okay, let's walk through this calculation because this is where the rule gets very, very real. You start with 365 days. You subtract out your non-working days, weekends, holidays, vacation, all that, to get your denominator on line 1H, which is your total days worked. Simple enough. Then, the form asks for the number of days you worked outside New York. But here's the trap. If those out-of-state days were for your convenience, you are not allowed to subtract them. They stay in the numerator on line 1L, which means a day you worked in another state is treated exactly like a day you worked in New York for tax purposes.
I know, this probably sounds pretty ironclad, right? Almost inescapable. Well, there is one very narrow path to proving your remote work is an actual necessity, but it has nothing to do with your personal situation. It's all about whether your home office can qualify as a bona fide employer office.
And that really is the million-dollar question for every single non-resident employee and their CPA. How do you possibly meet this incredibly high standard of proof? How can you actually show that your employer needs you for their own business reasons to work from your out-of-state home?
The answer is buried in a key piece of agency guidance. It's a Technical Services Bureau Memorandum, or TSBM, with the catchy name 065I.
This is the document that lays out this multi-factor, hierarchical test that is frankly notoriously difficult to pass.
And just look at this structure. This is not a flexible test. You've got two paths, and that's it. Path 1, you can meet a single, very specific primary factor. Or, Path 2, you have to meet a supermajority of secondary and other factors. We're talking 4 out of 6 of one list, plus 3 out of 10 from another list. So let's break that down.
So the whole game is about how many of these secondary factors you can prove. You need to hit at least 4 of them. And as you can see, this is not about casual telecommuting. We're talking about things like the home office being a formal written condition of your employment, or your employer not providing you with any space in their New York office. And this is a big one. Your employer reimbursing you for at least 80% of your home office expenses. And this requires a huge, documented level of cooperation from your employer.
Now, it is absolutely critical not to confuse this with the federal home office deduction under IRS Code Section 280A. I know they use similar language, but they are for completely different things. The federal rule is about whether you can deduct your home office expenses. New York's rule is about the fundamental taxability of your entire salary. The legal standards are just worlds apart.
So naturally, you'd think a rule this aggressive would have been challenged in court, right? I mean, taxpayers have argued for years that it violates the U.S. Constitution's due process and commerce clauses. So how's that gone for them? Well, the judicial record tells a very clear and consistent story. The state wins. Every time. From the very first major challenge way back in 1974, through major constitutional tests in the early 2000s with cases like Zelinsky and Huckaby, the courts have consistently sided with the tax department. And get this, most recently, even the COVID-19 pandemic and government shutdown orders weren't enough to meet the necessity test in the eyes of the Tax Appeals Tribunal.
And this quote from that recent Zelinsky II decision says it all. It clarifies that necessity isn't just about being unable to go to the New York office. The key is that the employer must need you to work in a specific, out-of-state location for a legitimate business reason. Just allowing you to work from home anywhere else is still considered your convenience.
Okay, so let's zoom out a bit now and see where New York's really unique rule fits into the bigger national picture. Because with the explosion of remote work, other states have been forced to react to New York's aggressive position.
This table really shows you the divide. You've got a handful of states like New York and Pennsylvania that have what's called a full convenience rule. But then, in response, states like Connecticut and New Jersey have adopted what are called reciprocal rules. Their version of the rule only kicks in if their resident works for an employer in a state like New York. It's basically a defensive move to protect their own residents and their own tax base.
And that really leaves us with this central, lingering question. In an economy where work is becoming detached from a physical location, is this rule just an outdated relic from another era, unfairly taxing people based on where their employer's headquarters happens to be? Or is it a vital, if maybe blunt, tool for states like New York to protect their tax base when their economic engine is fueling jobs that are being performed all over the country? It's a tough question. And for now, the rule isn't going anywhere. And that means understanding its forensic details is really your only defense.